Welcome to Talk Tickers. Today's going to be a little different.
Yeah.
Usually we're dissecting earnings calls, looking at, the minutia of a specific ticker. But today we're zooming out, way out.
And then all the way back in.
Exactly. We're going to look at the big picture dynamics of liquidity, but through a very specific lens that's probably keeping a lot of people up at night.
It's a real collision in two worlds today, isn't it?
Yeah.
We're taking this cutting edge model from, believe it or not, theoretical physics.
Right.
And we're smashing it up against the hard, messy reality of the private credit markets as they stand right now here in early 2026.
It sounds like science fiction, but it's very real. So here's the roadmap for this deep dive. First, we're going to talk about these things called the Navier Stokes equations.
Yep, normally used for designing jet engines or predicting the weather.
And we'll look at how they're being used to model economic flows and maybe even predict turbulence.
Then we're pivoting to the ground war. We'll look at the current state of private credit. I mean, you've got regulatory crackdowns coming from the DOJ, the SEC.
Huge valuation disputes.
And this really worrying rise in so-called interval funds that are pitching really complex debt to retail investors.
And finally, we'll connect all those dots to the one part of the market that's booming because of all this mess. Credit secondaries. If the system is clogging up, this is the pressure release valve.
It's all a story about flow, friction, and what happens when the pipes just get too narrow for the amount of money trying to rush through them.
So let's start with a theory. I think most people listening are familiar with the standard toolkit, right? You've got your CAPM, your value at risk.
The classics. We all grew up on them.
But the premise here is that those models are, fundamentally broken because they're static.
They are. I mean, traditional finance models assume the market is this machine that's always trying to find equilibrium. It assumes, if you just leave it alone, it will settle down.
Which anyone who's lived through a crisis knows is not true.
Not at all. The market isn't a machine. It's a storm. It's chaotic. And standard models, they're just terrible at predicting chaos. They see these huge crashes as outliers or black swans.
But the argument here is they're not outliers. They're just part of the physics of the system.
Exactly. Which is why some researchers started applying the Navier Stokes equations. They describe how fluids, liquids, and gases move. And the insight, it's actually surprisingly intuitive.
Money is a fluid.
Money is a fluid. We use the language all the time. Cash flow, liquidity pools, frozen assets.
Yeah.
This isn't just poetry, it's physics. If you map economic variables onto these equations, you get a much, much better predictor of when things are about to break.
Okay, let's break down the variables because this is where it gets really interesting. In the equation, you have velocity. In physics, that's just speed. What is it here?
Here, velocity is the speed of money circulation. How fast does a dollar move from hand to hand? In a hot economy, velocity is super high.
You get paid, you spend it, that business pays a supplier, and so on.
Right, the money just zips around. In a recession, what happens? Velocity plummets.
Yeah.
Everyone hoards cash. The fluid slows way down.
Okay, that makes sense. Then you have viscosity. So in a liquid, that's thickness, right? Like honey versus water.
This is the most critical variable for our discussion today. In this economic model, viscosity is internal market resistance.
Friction.
Perfect word for it. It's friction. What stops a deal from happening? Sometimes it's regulation, sometimes it's fear, but often it's the banking sector itself. If banks are under pressure and they stop lending,
The market gets sicky.
the viscosity shoots up, the market becomes sticky, capital literally cannot get to where it needs to go.
And then there's the pressure gradient.
Which in finance is basically inflation or price volatility, driven by supply and demand. And then, the variable that just ruins everyone's year, stochastic shocks.
The turbulence.
The turbulence, a sudden war, a pandemic, a surprise policy change. In a standard model, these things just break the math. In Navier Stokes, they're just another input that creates ripples or, tsunamis.
So they ran this model against real-world data from the country of Georgia, right? Over a 14-year period ending in 2024. And the output was kind of scary.
It was a classic calm before the storm signal. When they crunched the numbers for 2024, they found the velocity of money had dropped a lot, from 3.69 down to 3.46. That tells you the engine is sputtering.
But here's the kicker.
Yeah, the viscosity, the market stickiness was at 66%.
66%, that sounds incredibly high.
It's massive. It means that the banking sector was basically sitting on its capital. The pipes were completely clogged with market stickiness.
And this is why people miss these things. Inflation was low, under 2%. So on the surface, the water looks totally calm.
But underneath, the current has stopped. and the friction is sky high. And that combination, it creates a system with a really high beta. The model calculated beta of 1.2.
So it's hypersensitive.
Hypersensitive. If a shock hits, if you throw a rock into that sticky stationary pond, the reaction is violent.
Which brings us to this idea of a singularity. In math, that's where an equation just fails, right? Like the center of a black hole.
Or as the mathematician Terence Tao calls it in fluid dynamics, a blow-up. The velocity theoretically becomes infinite and the physics just breaks.
So what does a blow-up look like in a financial market?
It's a crash. It's the moment the pressure is so great and the pipe is so clogged that the whole structure just shatters.
Okay, so let's keep that image in our heads. A high-friction system, looking calm but ready to explode, because that feels like a perfect transition to what's happening in January 2026.
It's the perfect parallel. We're looking at the private credit market, and the viscosity is getting very, very real.
I mean, private credit was the golden child for a decade.
It was. It grew into this multi-trillion-dollar behemoth. But now, in 2026, the cracks are really starting to show. We're seeing pressure from the top down.
Let's talk about the regulators. For a while, it felt like private credit was in this gray zone, but it looks like the DOJ and the SEC have woken up.
Oh, they are on the warpath. The Department of Justice came out with a very specific warning about creative marks. And in our world, creative is the last word you want to hear about your accounting.
Creative accounting usually ends badly. What are they looking for?
They're hunting for valuation divergence. See, these assets, they don't trade on an exchange. There's no live price. The fund manager just decides what a loan is worth.
Mark to model.
Mark to model. And the DOJ is finding cases where Fund A says a loan is worth 98 cents on the dollar, but Fund B holds the exact same loan and marks it at 85 cents.
Whoa, that's not a rounding error.
Not at all. It implies someone, probably the one marking it at 98, is ignoring reality to keep their returns looking good and their management fees high, which is, fraud.
And at the same time, the SEC is going after the rating agencies. I saw a probe into Egan-Jones.
Yeah, for conflicts of interest. And that matters because the whole system runs on those ratings. Pensions and insurers rely on them. If an agency is just handing out investment-grade badges to junk to keep clients happy.
It's 2008 all over again.
It has that same bad feeling, doesn't it?
Jamie Dimon had a great line for this, the cockroach theory.
It's a gross image, but it's dead on. You see one cockroach, you know there are 50 more on the walls. And the cankroaches here are the recent bankruptcies we've seen. Companies like Tricolor, First Brands.
These were supposed to be safe credits.
Exactly. Their failure suggests the underwriting across the board might be a lot weaker than people thought.
There was also a really specific stress signal I saw involving BlackRock. One of their private credit CLOs breached its over-collateralization test. Can you unpack that? What is an OC breach?
Okay, so think of a CLO as a waterfall of money. Borrowers pay interest, and that cash flows down through a series of buckets. The senior guys at the top get paid first.
And the managers are at the bottom.
Right, catching the spray. The OC test is a safety valve. It just asks, are the assets still worth enough to cover the debt we owe to the senior guys?
And if the loans go down in value?
You fail the test.
Yeah.
And when you fail, the waterfall gets diverted. The spigot for the managers and the equity holders gets turned off completely. All the cash goes to pay down senior debt. It's a lockdown.
So the fact that it happened to a BlackRock vehicle...
The biggest player in the game. It's a massive red flag. It shows the portfolio is getting weaker faster than the structure was designed to handle.
So we have sticky markets, regulatory heat, structural problems, and yet we are seeing an absolute explosion of products trying to get average investors into this exact asset class.
The interval funds. This is where the story gets really concerning because it shifts from institutional risk to retail risk.
The numbers are just wild. 50 new funds in 2024, another 55 expected in early 26. Why is Wall Street pushing these so hard right now?
Because the institutional money is tapped out, the pensions, the endowments, they're full. Wall Street needs a new source of capital, so they're targeting, your doctor, your dentist, people who see stock market volatility and get scared.
And this product looks great on paper. A steady 10% yield, no daily price swings.
It looks like a haven, but it is not a savings account. And that word interval, that's the catch.
Right. The interval is the liquidity. They promise you can get your money out once a quarter, but the assets inside are illiquid private loans. You can't just sell one on a Tuesday afternoon.
So when you ask for your money back, where does the cash actually come from?
That's the dangerous mismatch. They're often using new money from new investors to pay out the redemptions from the people who are leaving.
Which sounds a little like a Ponzi scheme.
It's structurally fragile. I mean, it works perfectly fine as long as money is pouring in. But what happens if sentiment turns? Say, a bad headline about a DOJ investigation, and everyone wants out at once.
The math breaks. The fund just gates you. They say, sorry, we hit our 5% redemption limit for the quarter. You can't have your money.
And that creates panic, which just makes more people want to get out.
It's a classic run on the bank, just in slow motion. And what's really concerning is the SEC recently relaxed the rules on this. They increased the cap on how much of this illiquid stuff these funds can hold.
So just as the risk is peaking, the door for retail investors is opening wider.
And almost none of these funds have ever been through a real downturn. They've never faced a period of sustained net redemptions. We are running a live experiment on retail liquidity in a high viscosity market.
Okay, so back to our Navier Stokes analogy. We've got high viscosity, we've got these pressure gradients, and we have a very narrow pipe with these retail liquidity promises. The model predicts turbulence. Is the system heading for a blow-up?
That is the multi-trillion-dollar question. But, markets are adaptive. When pressure builds, it looks for release. And the market has built a massive pressure release valve.
The credit secondaries market.
The plumbing fix. The growth here is explosive. Volume doubled from $6 billion in 2023 to around $11 billion in 2024. Projections for 2025 are over $18 billion.
And there's a lot of cash waiting to buy.
Over $20 billion in dry powder. This is the market trying to lower its own viscosity. If the normal exits are blocked, no IPOs, M&A is dead, you need another way out. The secondary market is providing that exit.
But the deals themselves are changing, aren't they? It's not just investors selling their stakes anymore. It's the fund managers, the GPs, leading these deals.
It's what they call the harvest problem. Imagine you're a manager. You bought a company 5 years ago. You're supposed to sell it now, give the money back. But interest rates are high. No one's buying at your price.
So you're stuck.
You're stuck. You don't want to sell at a loss. So you create a continuation vehicle. You basically sell the asset from your old fund to your new fund. It extends the timeline.
Kicking the can down the road.
It is. But it also gives the original investors a choice. You can cash out now at a certain price, or you can roll your money into the new vehicle. It creates liquidity where there was none.
And the pricing on these deals seems to be holding up pretty well.
That's the good news in all this. High-quality senior secured loan portfolios are trading in the mid-90s, even at par. That tells you the smart money buying this stuff still believes the underlying assets are good. They're not pricing in a disaster.
So the cockroach theory might be true for some, but the market thinks the good stuff is still good.
Exactly. The secondary market is like a bypass. It's letting the pressure out of the system before we get that singularity, that blow up the physics model warns about. It allows the turbulence to dissipate without bursting the pipe.
So let's bring this all together. We've gone from theoretical physics to regulatory crackdowns to retail products. If you're listening to this, what is the one big takeaway?
I think the synthesis is about recognizing flow. The physics model teaches us that when you force a fluid through a narrow pipe under high pressure, you get chaos. The interval funds are that narrow pipe. The regulatory scrutiny is the pressure.
So what's the move?
The move is to re-underwrite. You have to throw out your assumptions from 2024. Treat credit ratings as marketing opinions, not as gospel truth. And you have to look for covenant discipline.
Look for deals that have actual rules and protections.
Precisely. We're coming out of this covenant-light era where borrowers could do whatever they wanted. Now, you want hard covenants. You want tripwires that let the lender step in if things start to wobble.
And for that retail investor who's looking at that shiny 10% yield.
Be realistic about liquidity. If you buy one of these funds, you need to treat it like a 5-year commitment. Do not put your emergency fund in there. Understand the gates. Understand that you might not get your money when you want it.
It really all comes back to the physics, doesn't it? You can't cheat fluid dynamics. If the flow stops, the pressure has to go somewhere.
And it usually goes to the place you aren't looking. That's the epsilon in the model, the unintended effect. The system will find a way to clear the blockage. The only question is whether it does it smoothly through the secondary market or violently through a crash.
I want to leave everyone with a final thought to mull over. We always talk about black swans in finance, these rare, unpredictable events. But when you look at all this data, the physics of the flow, the warnings from regulators, the clogged pipes, is a crisis really a black swan if the math itself is predicting it? Or are we just choosing to ignore the weather forecast because we like the view from the beach?
That's the trillion-dollar question.
Yeah.
Are we watching the storm form? We're just hoping it blows over.
Something to think about. Thanks for listening to Talk Tickers. We'll catch you on the next deep dive.